We're going to talk now about what's called the assignment of income doctrine. The assignment of income doctrine. And it's something that happens more often than you would think, but it's just not something you can do. People don't mean to be defrauding, perhaps, but we talked once before about tax avoidance and tax evasion. A lot of people, you'll see in these examples, people think they're avoiding tax, but what they're actually doing is evading it. So we have the assignment of income doctrine. And it says simply that the income is to be assigned to the taxpayer who earned it. The income is to be assigned to the taxpayer who earned it. And if for some reason it somehow wasn't assigned, the IRS will assign it for you. And in all likelihood, they will assign it to the taxpayer who is going to be in the highest tax bracket. So you need to be careful. Let me read a couple points to you, because it really makes it simple, I believe. If we're talking about people who are earning or receiving compensation, whether it's as a sole proprietor or as an employee, the person who performs the service earns the compensation. The person who performs the service earns the compensation. Now remember, when we say person, we talked before about different types of entities. The person might be an individual, it might be a C corporation, it might be an S corporation, but whoever performs it earns the compensation. If we're talking about something is sold, an asset is sold, the person who owned it is the person who gets the assignment of income. Let's say that somebody's going to rent out an asset or lease an asset to somebody else. It's the person or the taxpayer who owns it that is going to have the income assigned to them. That is a fairly simple concept, I believe, and I think the examples make it pretty straightforward. It's just that a lot of people would like to think that it's different when it's not. So again, we said the person or the taxpayer who earns the income, it's going to be assigned to them, and they cannot just willy-nilly on their own decide to assign it to somebody else. Okay? And you can run into this a lot, not too much with larger businesses and corporations, more likely to run into this when you're dealing with closely held corporations. Let's say an employee or owner-employee directs all or some of their income to a child. Now, you can't just willy-nilly, you have some income and decide suddenly that, well, that was really my child's income or my grandchild's income. Okay? It's income to the person who earned it. Now, if it's a small, closely held business or corporation, there's nothing wrong with employing your child or grandchild. That's fine. But, they have to do some work. And what they get paid has to be reasonable. Okay? So you can't just shift income out of your pocket into somebody else's pocket because they're in a lower tax bracket. Whether it's a child or maybe it's your sibling, a brother or a sister, maybe it's a parent or a grandparent. Just because they're in a lower bracket, you can't automatically decide that it's theirs. Now, if you want to be able to say that a gain from the sale of a stock or a bond was the person in the lower bracket, they have to be the owner. Name has to change. So, you want to be careful about it. We run into that sort of thing a lot. especially when people have children. I tell people a lot as a way of tax planning. There's a lot of benefits toward employing a child or a person in a lower tax bracket, but especially with a child. A child doesn't have to be too old to know the alphabet. So that means they can do filing. A lot of young kids would find it hard to believe today, but young children can actually take out the trash. You can have them do things, and it teaches them work ethic, it teaches them responsibility, and you pay them. Now, when it comes to things like interest and dividends and so forth, you can gift assets to your child, and those assets, cash, stocks, bonds, can earn interest and dividends, and it is attributable to the child. However, if the child has unearned income over a certain amount and little or no earned income, you'll find that they will be taxed at the parent's rate. We call it the kiddie tax, but I'm sure there's a nicer name for it in the code. So the person who earns it is the person who is going to pay the tax on it, and they can't just willy-nilly shift it off to somebody else.